major stock indices at session lows right now. Treasuries aren't trading today for Columbus Day, but certainly the market is reacting to this spike up in rates, and it's left a lot of investors concerned. Joining us now to talk about it is Jim Paulsen, Chief Investment Strategist at the Leuthold Group, and Dana Peterson, economist at Citigroup. Jim, we just came off of the worst week for the NASDAQ since March, so Russell as well got very beat up. And the mood has turned sour again this morning. What's driving it? Is this fear of rising rates?
Well, I think that's certainly part of it, Sarah. You know, a follow through from what we went through last week, and perhaps more to come. We're going to face both PPI and CPI reports later this week yet. But I also wonder, not only is the overheat pressure now on Wall Street's mind, but the real kicker would be now if real growth slows, not only here but globally. And I think there's some growing evidence that that may be the next shoe to drop. We've already had the OECD leading economic indicator for the globe roll over. Has been coming down in the last few months. And here in the United States, we've got, cyclicals that are getting beat up. You've talked about it earlier that it isn't just today, but you go back to utility stocks have now matched the market since like January 5th of this year. Staple stocks have matched the market performance since almost April. You've got a good part of this market in recent months that's been led by defensive stocks. They can't be saying, rates is the primary reason. I think it has more to do with nervousness about growth. And if you put that together with 10% drop in industrial commodity prices since June, and weak housing, weak autos, weak durable goods spending, if we drop growth right now and remove those fantastic fundamentals and we leave a higher rate structure in place, that's where the pressure would really intensify on stocks.
So if it's a global growth story, Dana, the question becomes, how resilient is the U.S. going to be? I mean, we just got another very strong employment report, especially with that lower unemployment rate. How strong is the foundation to withstand a downturn in global growth that looks, as Jim said, a little worse than first appeared?
Our forecasts have the U.S. continuing to lead the global economy. Indeed, there are a lot of concerns about slowing in China and emerging markets and also potentially in Europe. But remember, we had roughly 4% growth in the second quarter in the U.S., and we're looking at probably 3.5% growth in the third quarter, and maybe again 3% in the fourth quarter. So even though those numbers, 3.5%, 3% are lower than 4%, and we're still looking at very significantly strong growth in the U.S. economy. We're still growing materially above potential, and we think that there's still more room to run with respect to the boost from tax reform and certainly the Bipartisan Budget Act on the U.S. economy, not only for the balance of this year, but also for next year.
Jim, I know we're talking about rising rates right now and the potential for slowing global economic growth. Earnings season kicks off in earnest later this week with the banks. If we get strong numbers out of companies, I should say, does that change the narrative here?
Well, I think, I think it's more than just needing strong numbers at this point. You're going to need numbers that are much stronger than where Wall Street's expecting. That's what really it comes down to. So we're going to have a good third quarter, no doubt about it, in terms of just the raw numbers for earnings. The question will be, is it going to beat the whisper numbers that's in Wall Street's minds? We've had an abnormally large number of companies already revise down or guide down guidance. I think almost more than 100 companies, which is odd, and certainly a bit of an outlier. I also wonder if we'll find some companies in the earnings season, Brendan, that report some margin pressure. Now that we've got some of these hotter inflation numbers, cost pressures. You've certainly got energy cost hitting company budgets. If they start to report margin pressures and also revise down growth estimates into the next year, that could be a very difficult thing for the stock market, even if the raw numbers are still pretty good.
Dana, one of the other things to focus on is actually going to be D.C. in the coming weeks. We're less than a month away from these midterm elections. We had played tape from President Trump earlier in the hour alluding to this, the fact that you're actually potentially, according to some of the GOP leadership, starting to see stronger numbers in the polls in terms of Republicans looking to come out and vote. It seems like the market has priced in the House swinging to the Democrats. What if it doesn't?
Well, certainly that alternative scenario is quite likely in our view. And if you see the GOP maintaining control over both chambers of Congress, we think it's more likely that we'll see tax reform 2.0, probably increased deregulation, as well as potentially some erosion of the Obamacare. I think the key thing for the president is he likely would see that as a mandate for him to continue his policies with respect to lightening up in the financial sector, with respect to deregulation, as well as for the environmental sector, and also with respect to trade. Indeed, he may continue to go long in his policies of addressing trade imbalances, particularly with respect to China. So it's certainly something that markets cannot discount.
So Jim, Dow's down 182 now, reaching new lows for the session. What's your advice? I mean, a lot of people listen to you. You were super bullish on the run-up over the last few years. You've been sounding a lot more cautious lately.
Yeah.
Do you reduce your exposure to stocks, go into cash, go into fixed income? What are you telling people?
Well, at this point, I don't see recession. And without a recession, we probably don't have a sustained bear market. That could change, of course, Sarah. So I wouldn't totally exit, but what I would do definitely is diversify. I would certainly have an overweight on those defensive sectors, more so than anything else. I would probably move away from the United States. I know the emerging markets might continue to get chewed, but I would have a little of those as well as the international developed. I think there's going to be more pressure here in a sell-off than abroad. I would add a commodity ETF to the mix rather than just all equities. I would raise a little bit of cash. You're going to get 2.5% by the end of the year from the Fed. Overall, I might have a little bit of intermediate bonds rather than pure stocks. I might introduce some hedge fund-like approaches that could give me mid-single-digit returns if the market keeps running, but not as much downside. So I think the issue at this point is more of a defensive diversity than it is a complete exit from this thing. If it does correct good,
diversity.
and we don't have recession on the horizon, then I think there could be another buying opportunity sometime later. But a correction to me, one that scares people about recession, is looking increasingly likely over the next several months.